Jeff Bangerter from Bangerter Financial Services with the week on Wall Street for October 5th, 2020. Stocks advanced last week, propelled by hopes that legislators may reach an agreement for a new fiscal stimulus package and optimism generated by a few corporate deal announcements and initial public offerings. The Dow Jones Industrial Average rose 1.87%, while the Standard & Poor's 500 increased 1.52%. The NASDAQ Composite Index gained 1.48% for the week, and the MSCI EAFE Index, which tracks developed overseas stock markets, advanced 1.56%. The summer brought an economic rebound and a continuation of the stock market rally that began in the spring. In late September, the Federal Reserve Bank of Atlanta estimated real gross domestic product growth of 32% for the third quarter. All three of the major Wall Street benchmarks advanced in the third quarter. The S&P 500 added nearly 8%, ending the quarter up about 4% for the year. Even so, U.S. equities slumped in September as traders worried that the stock market might be getting ahead of the economy. In Washington, the Federal Reserve altered its monetary policy stance and forecasted low interest rates for the near future. Hopes for another economic stimulus dimmed in Congress. On Main Street, the coronavirus pandemic remained top of mind, but improvements in hiring, consumer confidence, and retail sales were evident. Entering the fourth quarter, analysts wondered how skillfully the financial markets might manage some unknowns. A potential uptick in COVID-19 cases in the fall, the pace of vaccine development, the outcome of the presidential election, and the undetermined prospects for additional economic support of businesses and households. Many positive signals appeared in the quarter. Millions of Americans went to work again. Monthly net job growth topped 1.7 million in July and 1.3 million a month later. Unemployment, which had hit 14.7 in April, fell from 10.2% in July to 8.4% in August. And the U6 rate, counting both unemployment and underemployed, dropped to 14.2%. Consumer confidence, as measured by the Conference Board Monthly Index, leaped to 101.8 in August from 86.3 in July. Households kept up their buying. Retail sales were up year over year through August, even though supplemental unemployment benefits expired at the end of July. Industries also grew, according to research from the Institute for Supply Management. When the ISM's monthly Purchasing Manager Index for manufacturing and service sectors surpasses 50, those sectors are judged by the ISM to be expanding. The ISM Services PMI was at 58.1 in July and 56.9 in August. Its manufacturing index reached 54.2 in July, a month that saw a 6.4% rise in U.S. factory orders, and 56 in August. Home sales soared as summer began, and although that momentum tailed off, sales did not retreat. Residential resale were up 24.7% in July and another 2.4% in August. New home buying also increased 4.8% for August, and after a 14.7% July climb. So housing starts and building permits were both up 17.9% of the first month of the quarter. But then they both declined. Permits dipped 0.9% and starts 5.1% in the 8th month of the year. For more than a century, the Federal Reserve has had two primary monetary policy objectives: to manage inflation and to guide the economy toward a state of maximum employment. Historically, managing inflation has come first. So it made news on August 27th when Fed Chairman Jerome Powell announced that the central bank would seek to achieve inflation that averages 2% over time, rather than proactively adjust short-term interest rates when inflation approaches that established target. In other words, it would tolerate a little more inflation than it had in the past as a trade-off for spurring the economy. The Fed kept the federal funds rate between 0 and 0.25% range in the quarter, and its September consensus interest rate forecast showed it expected no change until 2022. As economies worldwide continue to labor under the coronavirus pandemic, The International Monetary Fund, or IMF, and Organization for Economic Cooperation and Development revised their estimates of global economic activity for 2020 and 2021. The IMF sees a 3% contraction for global gross domestic product this year, with the global economy growing 5.8% next year. The estimates, again, from the OECD, they have a 4.5% pullback for global GDP in 2020 and then a 5% rebound in 2021. The quarter ended with no agreement yet on a post-Brexit trade deal between the United Kingdom and the European Union, as post-Brexit transition period ends December 31st. Complicating matters, UK lawmakers introduced a bill that would disregard conditions for trade with Northern Ireland established as part of Brexit, which the EU has hotly protested. UK Prime Minister Boris Johnson wants both parties to reach a free trade agreement this month. Johnson is aiming for a pact without quotas or tariffs attached, similar to the agreement the UK had with Canada. Looking at foreign stock exchanges, some significant quarterly gains stand out. South Korea's KOSPI index rose 11.2% in 3 months. No other consequential overseas benchmarks advanced double digits in Q3. China's Shanghai Composite added 7.82%. Taiwan was up 7.7%. Argentina was up 4.69%. Japan's Nikkei rose 4.02%, and Germany's DAX 3.67%. On the other side of the ledger, Hong Kong's Hang Seng retreated 3.96%, and Spain was down 7.12%. And then the MSCI EFA index, which again tracks large companies across developed countries in Europe and Asia, rose 4.9% in Q3. Stocks powered through July and August, entering historic territory in midsummer. In particular, August saw a powerful rally. The NASDAQ composite climbed 9.59% in August, and the Dow Jones Industrial Average gained 7.57%, finishing with its best August since 1984. Then, reservations about rallies surfaced. Traders began to question the sustainability of the summer economic recovery and whether a fall uptick in coronavirus infections might hurt businesses and consumer spending. The S&P ended up September at 3363, retreating 3.9% for the month. The Dow lost 2.28% in September to fall to 27,781, and the NASDAQ gave up 5.16%, declining to 11,167. The 10-year Treasury yield spent all quarter between 0.32 and 0.4%, reaching the top of the range in late August. Wall Street entered its fourth quarter with a bit of uncertainty. The November election results may produce any number of reactions. There are only educated guesses as to when the coronavirus vaccines may appear and how effective they may be. The first reading on third quarter gross domestic product growth is on October 27th, roughly 1 week before Election Day. Federal Reserve officials expect low interest rates and very little inflation through 2022. Sustained low interest rates could drive more borrowing and business investment and improve the outlook for the housing market. All right, for the week ahead, the key economic data. Monday is Purchasing Managers Index and the Institute for Supply Management Services Index. Tuesday, we have job openings and labor. And then Wednesday, Federal Open Market Committee, or the FOMC meetings. Thursday, the jobless claims will be out. And then this week, companies reporting earnings. Pretty light this week. We have Tuesday, we have Paychex Inc. and Levi Strauss, and that's it. So that's your week for October 5th of 2020. This is Jeff Bangerter with Bangerter Financial Services, home of the fiscal bridging formula, saying thanks for watching. If you have any questions, give us a call at 916-965-1879.